Welcome back to the Self-Educated Economist channel. This one we're going to be Personal Finance 102. Now in the first video, which was Personal Finance 101, we went over assets and liabilities, balance sheets, and different of things, different terminologies, assets, what wealth actually is, and in this one we're mainly going to talk about debt. Now, I know most everybody knows what debt is. It's when you take a loan out for something. But there is times when debt is good, and there's times when debt is bad. And I'm not referring to bad debt as those that's on the bank's balance sheet that somebody didn't repay and they had to write off and send to collections. I'm referring to bad debt as debt that where you've had to spend to consume something that you don't get no return on. So let's dive into this. We all know that debt is a loan. It's when you go and borrow some money from a bank or a finance company or maybe your best friend, and that makes you a debtor and then the debtee. So you begin, then you have to make payments on that debt. So you say, well, how can debt be good? Well, debt can be considered good if you're using that debt. A lot of people consider good debt to be to buy a house to live in. Some people consider good debt to be to buy a car. Now I'm going to throw the notion out here that debt, good debt, should pay you to own it. Just like an asset. If you take out debt, for instance, if you go in debt to buy a rental house, okay, now this debt could be good if you go in debt for the rental house and say you have an RV ratio of 2 or 3. In other words, somebody's paying you 2 or 3 times what your total expenses are on this rental house in order for them to rent it from you. So if you have a payment of $500 to make it easy, we'll say you have a payment of $500 and they're paying you $1,000 a month rent. That would be considered good debt because you're getting paid, even though it does cost you $500, you're getting paid at the end of the month $1,000 on that. So you're taking your $500 and putting it in your pocket and taking the other $500 and paying the bank with it. That's an example of good debt. Whether that be on a credit card. Say you need a tool if you're a contractor and you said, well, I can go down here and use this credit card and pay for this $300 tool, but then I'm going to turn around and use this tool to make $500, make something I can sell for $500 and pay the debt back. That's an example of good debt. Now, what is bad debt? Bad debt is where you spend it just to consume. You don't, say for instance, you didn't have to go to the big restaurant tonight, but you decided you wanted to, and you get there and you don't have enough cash to pay the bill and you put it on a credit card. Well, that meal is only going to supply you with so much energy, and you just took out debt on a credit card to consume that food, for instance. Or maybe it's to go buy a new TV. The TV you got works. You don't need it. Or maybe you do need it, but you're consuming and it's not paying you anything. All you're left with is a payment at the end of the month. That is bad debt. That is debt you want to avoid. Now, let's get into loans. In my last video, I talked about how that the loan on for a house could actually be an asset on your balance sheet. So, let's just go ahead and start with the Bureau of Labor Statistics. It says the CPI for December of 2021 was 7%. Core CPI was 5.5%. Okay. Now, starting with these numbers, if we look into our loan, say you buy a house, and that house has a percentage rate on the loan of, let's call it 3%. Okay, well this 3% year over year, the way they calculate this would be take what you owe at the first of the year, and then multiply that by 3%, and then divide it by 12. That'd be an APR, it'd be an annual percentage rate. You get charged that rate annually. As long as your annual percentage rate is less than the CPI number, or the rate of inflation, you're making money on that loan. Just to have the loan, you're making the money. In other words, you took that loan, if you bought a house with it, say for instance, or you used that loan to start a business, well, you take that 3%, the difference, the spread between the 3% and the 7%, which is going to be 4%, is the amount of money that you're getting to keep in your pocket over what it should have been costing you. Because in order for this to be zero, in order for there to be a zero real rate, and if you listen to CNBC or you listen to Yahoo Finance, sometimes they'll come across nominal rate and real rates. A nominal rate is what the bank charges you. Your nominal rate in this case would be 3%. But in order for the real rate to be zero, this loan would have to have at least a 7% interest rate. So basically, they're giving you the money at 3% in order to write you the loan. You're gaining 4% in purchasing power over the life of this loan. So that is how your loan becomes an asset on your balance sheet. If it's for a house or a rental house, or if it's for say you own a business where you have to drive a lot and you go get a new car, and you can write the mileage off on your taxes, maybe in some of the expenses, the maintenance and different things you can use for tax write-offs. And this is another way you can help put money in your pocket. So, on our next video, which will be Personal Finance 103, we're going to look at different tax brackets. And not exactly the bracket as far as what that bracket would cost you, but we're going to look into difference of how taxes are filed between corporations and between the personal level and the employed, the self-employed, and the business taxes. And I'll show you another way that rich people stay rich. So come back, and it'll be Personal Finance 103. So stay tuned for more content. Like and subscribe to support the channel, and have a good day.